All right. So we got 1 minute before things kick off. Hope everyone's having an awesome day today. If you're in Rochester, it looks like a pretty beautiful one. I'm thankful that you have elected to share the day or share the next 15 minutes with me. It is now 12:30, so we'll kick things right off and get things going. All right, so welcome to another round of the TeleK, what you need to know about your 401k right now, and presented by Sage Rutty. So to start things off, my name is Craig Gingerich. I'm a certified financial planner, accredited investment fiduciary, and a certified health savings advisor here at Sage Rutty. Some of the ground rules, some of the guidelines, designed to be 15 minutes to make sure it's a valuable use of your time. If you don't mind just saving the questions for the end, very happy to address them. And always just a reminder that we're here as a resource for you. I like to make the point, if you walked in off the street to our office and wanted to do some financial planning, the going rate is $300 an hour. If you're one of the employees of our 401k plans, somebody that we work with, if you come in, the going rate is free. So take advantage of it. It's a really nice resource. We're here to help in everything in life with a dollar sign next to it. So without further ado, what are we talking about today? The first topic is talking Roth versus pre-tax, which I'm really excited about. We've had a ton of questions coming in about this, especially given how 2020 has been shaking out. The second topic is on sequence of returns risk, which we've had exactly 0 questions about, which is a little problematic. I think it's something that people aren't aware of, but that can definitely hurt you. And then the third is, as always, actionable steps, right? How do we turn what we're talking about today into actual, dollar savings or dollar making techniques? So let's dive right into Roth versus pre-tax. And before the meat and potatoes, I got to address the question. People always ask, if I'm paying taxes now or I'm paying taxes later, what's the point? Right? What difference does that make? And I'm glad you asked. Let's take a quick look. So the basics of pre-tax, so traditional, kind of what people picture when they're picturing a 401k plan, is you get a nice little tax break on the front end, right? The dollars you put into that pre-tax account, you deduct from your taxable income, you save some taxes right now. It grows, it compounds. At retirement, when you take it out, you then pay taxes on the back end. Now, if you look at the Roth, it's kind of flip-flopped, right? So Roth doesn't carry any tax advantage on the front end, right? You still pay with after-tax dollars into the account. That grows and compounds. And when you take it out in retirement, there's no tax on the growth. The growth is tax-free, which is awesome. If you look at a taxable account, so like a brokerage account or your bank account, or if it doesn't have an IRA or 401k umbrella to it, it's a taxable account. How those work is there's no tax deduction on the front end, right? It's still all ordinary income. And then every time that you receive a dividend, every time you receive interest, every time that you have to recognize capital gains, you're paying taxes all along the way. So we talked about the growth and compounding with pre-tax and Roth. Certainly a taxable account can grow and compound, but kind of with a headwind to it, right? It's got some drag to it because you're having to pay tax on that growth along the way. So pretty clear, doing it in a tax advantage way, like a pre-tax or a Roth account, makes sense. How do we figure out which one, right? Which one makes the most sense for me? How do I save the most in taxes? If you are in the exact same tax bracket now and in retirement, Roth and pre-tax end up in the exact same spot. So a lot of it is kind of figuring out, what is my tax bracket going to look like, and based on my situation and on changes, what makes the most sense. So let's start at the kind of basic level so that everyone's starting from the same point of understanding as far as how income taxes work. So we'll look at kind of federal income taxes because it's pretty universal. If everyone tuning in is going to be affected by federal income taxes. The first dollars that you earn, you don't have to pay tax on. So there's something called the standard deduction versus itemized deduction. So the IRS recognized, we shouldn't be charging tax on everything that you make, because there's some things that, I'd kind of be double dipping on. So they said things like charity, things like excessive medical bills or other taxes that you're paying, we're not going to charge you taxes on. And so if you want to keep all your receipts and document all of that and show us, okay, here are the things that I get to deduct, that's great. And that's called itemized deductions. Or you can take what they call the standard deduction. So they say, we assume that there's some things that you shouldn't have to pay tax on. And here's what we'll assume. So if you're a single person, you can take the standard deduction, assume $12,400. You don't have to keep receipts. You don't have to justify any of it. It's available to every person filing their taxes as unmarried, right? So the first dollars that you earn, you're paying 0% tax on. Above that, so for an unmarried person, if we look at, let me just get the highlighter out here. So for an unmarried person, the first $12,400 they make, they pay no tax on. The next $9,700, they're paying 10% in that range. When you go beyond that, it starts paying 12%, then to 22, then to 24, and continues upward, right? And I think it's important to understand. So say that you're making $120,000 per year and you're unmarried, right? You fall in this 24% bracket. But that's different than your average tax being 24%, right? It's just the dollars above this 84,000 that you're paying 24%. Your average tax is much lower because you've gotten to pay 0% and 10% and 12 and 22 along the way, and only your top dollars are paying that highest rate. When we carry that into looking at Roth versus pre-tax, on a very simplified level, it's, okay, I know my bracket right now. In retirement, I'm going to be in a lower bracket. I want to do pre-tax, right? If I'm high earning years, in retirement, I'll be spending less. I want to do pre-tax. If instead you say, well, right now I'm in a lower tax bracket, I'm just starting my career, but in retirement, I'm probably going to be in a higher tax bracket, right? I just graduated college and I'm eating tuna fish every meal. When I retire, I'm going to be having steak twice a day. If that's the case, right, do the Roth, pay the lower tax bracket you're in right now, because later on, you'll probably be in a higher tax bracket. And when you take from the Roth, you don't have to pay any tax on it. So that's really the very basics on Roth versus pre-tax. Because it's tax, it's never that simple. So a couple of things I want to point out. At retirement, there's a few things that change. So besides the people that say, oh, I'm going to not have, to drive to work every day, and, I'll have my mortgage paid off, and, my expenses will just go down at retirement. Maybe, right? That's kind of a case by case basis. Universally, there are some things that will drop your tax bracket in retirement. The first is that Social Security is taxed differently. So not all of your Social Security will be taxable in retirement. Either 0% of it's taxable, 50% of it's taxable, or 85% of it's taxable. But across the board, you never have 100% of your Social Security taxable. So that right off the bat drops your tax bracket. The next piece is that there's also a larger standard deduction for individuals over age 65. So once you reach age 65, the IRS says you get to tack on an extra $1,300 per person into your standard deduction. You get an extra $1,300 tax-free, right? Another nice advantage, lowers your tax bracket another step. Also at a state level, so thinking about state income tax, some states have other exemptions that go along with it. I think many people are familiar, if you worked for the state, the pension that you receive is tax-free. But there's also a nice advantage for the rest of us that don't get to work for the state. In New York State, the first $20,000 per person that comes from a retirement account in retirement is New York State income tax-free. So not bad. $20,000 is not a meaningless amount of money. It is important to note that it's $20,000 per person, and it has to be from that given person's account. So I often run across families that they have two spouses. Spouse A is the primary wage earner and ends up doing 100% of their retirement savings, and spouse B doesn't do any retirement savings. In retirement, they're kind of hampering their strategies. So each spouse can take from their own account up to $20,000 without New York State income tax. but you can't take 40,000 from one and get the full deduction. You can only take 20 from each individual can take 20 from their own account. So if you are in a spot where it's okay, I'm working, I'm the primary wage earner, I'm doing all the retirement savings, maybe it's a good time to do some savings in the other person's name. So even if they don't qualify for a 401k plan, you can do a spousal IRA. There's other avenues, but a good opportunity to take a look and set yourself up better for retirement. The second piece, not to get off on too much of a tangent, the second piece is that New York State does not tax Social Security, which cannot be said for every state. So if you can believe it, New York State, not that bad for taxes and retirement, because they get you enough while you're working. A couple more things to complicate the equation. If you plan on moving in retirement, certainly take a look at where you are in your current state's tax brackets. And if you're moving to Florida, you're moving to Tennessee or a state that doesn't have income tax, do as much pre-tax as you can, right? Avoid state income tax, take it out in retirement. In a state that has no income tax, fantastic. If you see a change in income in any given year, so in 2020, we saw a lot of people, see a reduction in hours, a reduction in income. If you're in a lower income year, do the Roth account, right? You're in a lower tax bracket this year, save as much as you can into Roth, because that's not always the case. If you're in a lucky spot where you see you got a big bonus one year and spikes you in a higher tax bracket, do the pre-tax, get the deduction while you're in the highest tax bracket year. And then the third piece, which is the great equalizer, is that tax rates are always subject to change. They are always on the table. And actually, we're slated for a tax hike to kick in after the year 2025. So in the year 2025, our current tax code sunsets and reverts back to what 2017's tax code looked like. So if you remember a couple years ago when there was a big tax reform and everyone saw a little bit more pop into their paycheck in 2018, well, our politicians have scheduled for us to see that reversed in 2025. So what that looks like for you, so I put a side-by-side of 2017's versus 2018's up here. The biggest single change that came out of it is they nearly doubled the standard deduction. So it went from, for an individual, $6,350 up to $12,000. Pretty dramatic when you consider those are the dollars that pay zero tax. Then along the way, you can see, 10% is the same, but 12 versus 15, 22 versus 25. And why this is relevant is this is with a cost of living adjustment, this is where we're slated to go in 2025. So we're headed towards a higher tax environment. For an example, I tossed up somebody making $60,000 a year. The difference in total tax is not meaningless, right? It's almost 50% more tax. If you're making $60,000 a year today and $60,000 a year in 2026, you'll end up paying, about 5% more in tax, which is a little astounding. So that is a good equalizer, or kind of a really big question mark when you say, okay, well, all of what I was thinking makes sense for pre-tax, but now if I think that that Congress is going to have higher tax rates when I'm retired, maybe I am in the lowest tax bracket I will be, right? I'm in 24% and it's really hurting, but in retirement, I could still end up in one step down on tax brackets and in a higher rate, which is crazy. So something to keep in mind. If you want to have a deeper conversation, very much happy to do so. But I'm running a little behind on time, so I'll continue to move forward to our second topic, which is the sequence of returns and sequence of returns risk, which is basically the question of, does it matter if I get a low return this year and a high one next year versus two middle of the road ones? If you tuned in 2 weeks ago for my TeleK, I shared this graph, right? Which is that the average was 10%, but only 6 times in the last 95 years have we seen it within that 10% range. And so does it make a difference, right? The high highs and the low lows, does it really make a difference versus, just having a steady average? The answer is it depends. It could and probably will for a lot of people. So let's look at an example here. So say that you have $1 million in the account, and client 1 has $1 million, client 2 has $1 million. And client one was just pretty unlucky at the start of things, right? They had all of their bad returns at the start of things, versus client two had all their best returns at the start and the worst returns at the end, right? So they're just flip-flopped. They got the exact same returns and just in opposite order. And it turns out that they end up in the exact same spot, right? They end up to the penny exactly the same, right? They got the same 5.1% rate of return on average, brought them to the exact same dollar amount. So that's great. So it says that the volatility doesn't make a difference. But when you look at the same exact situation, you have the same $1 million, you have the same 5.1% rate of return, but you start drawing from it. So these are now two retirees, right? They started with $1 million. They're spending $50,000 a year from the account. They got, again, the exact same returns, but in opposite order. Pretty meaningful difference, right? If we look at it, client two, who had the best returns at the start and worst at the end, ended up $440,000 better off than client one, who had the exact same returns, but in opposite order, just started out negative and got better. So a little bit scary when you think about it, that, just the order of events can make that much of an impact. How you plan around it, how you deal with this is when you're getting ready for retirement, when you're getting ready to turn your 401k into income, it's making sure that you have a plan to deal with the down years. So if you saw a 20% return, the last thing that you want to do is sell out of your stocks, sell at a 20% loss. But having some cash on hand, having a laddered CD or some sort of income strategy to account for that mitigates that risk, right? You don't have to be selling from your stocks when the market's down. So I'm running out of breath here, just very excited and passionate about both of these topics. So hopefully they resonated with you. The third piece, as always, actionable steps. How do you turn what we just talked about into strategies for yourself? Step one, put together a tax projection. So take a look at what you think you're going to earn for the year and then see where that falls tax bracket wise. A lot of people, when asked, what tax bracket are you in, have no idea, right? Or just feel like they give up half of their money to the government. While that might be true, it's important to know exactly what the shakeout is. The second thing that you can do is consider longer term projections. Consider Roth versus pre-tax contributions from a lifetime standpoint. So if you're saying, I know based on my 2020 projections where I fall, time to sit down and think about, okay, when I'm retired, I will have the mortgage paid off. But I also think that we're probably going to see higher tax rates. Maybe I should do Roth, right? So to take a more grand look, take a kind of step back from your retirement, from your year-to-year planning, and take a look at your full retirement planning and make that decision. And then the third is make sure you're adjusting your investments as you approach retirement. I can't say this strongly enough. The strategy that got you from day one of work to to year 30 of work is not the same strategy that you should have from day one, from working to retirement. When you turn it into income, the strategy definitely changes, and make sure you adjust your investments accordingly. So last and most importantly is thank you. Thank you for your time today. Thank you for taking a couple minutes out of your day to listen in. I hope that it was a valuable use of your time. And thank you for the business and trust that you place with us at Sage Rutty. We do not take that lightly. I'm happy to address some questions now. If you're familiar, there's a Q&A button built into Zoom. Please feel free to utilize it. I know that just by the nature of taxes, it's very individualized. So if you'd like to set up some time, we can certainly chat via Zoom or phone or email, and then are doing select rollout as we continue to re-enter the workforce, doing select visits to some workplaces. So if you need it a little more personalized, or you want to just have a conversation on, here's my information, Roth or pre-tax, please don't hesitate to reach out. My email and phone number are right there. And again, happy to address any questions, and appreciate your time today. All right. No questions rolling in quite yet. Means I got to start bribing people to submit some softballs. Maybe have mom signing in for the TeleK or something, and toss in some easy questions. Um, Thanks for tuning in today. Again, I appreciate your time. Appreciate the business that you place with us. And if you have questions that you have in your head and are afraid to ask in front of everybody, just shoot me over an email or give me a call. All right. Thank you, everyone.